Hey everyone. Welcome back to the channel. I'm so glad you're here. Today, we're diving deep into a topic that's been creating a lot of buzz in the investing world. Weekly dividend payments. You've probably seen the headlines, ETFs and stocks that promise you cash every single week. Sounds amazing, right? Imagine getting paid every Friday just for holding certain investments. But here's the question we're answering today: is this too good to be true? Are weekly dividend-paying ETFs and stocks a real income solution, or are they just a clever marketing strategy to attract investors? We're going to expose the truth, the good, the bad, and the risky, behind those weekly dividends. So, grab your coffee and let's get started. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. First things first, what exactly are weekly dividends? Most traditional dividend-paying stocks and ETFs distribute income quarterly, 4 times a year. Some pay monthly, which investors love for that smoother cash flow. But now we're seeing a new wave of products that pay every single week. The most common examples: YieldMax ETFs like ULTI, TSLY, NVDY, and MSTY, certain closed-end funds, and even some option income ETFs that use covered call strategies to generate consistent premium income. The idea is simple: instead of waiting a month or a quarter, you get smaller dividend payments every week, often on Fridays. Sounds perfect for retirees or income-focused investors, right? But let's look closer. Here's where things get interesting. Weekly dividends don't just magically appear. These funds are typically using option income strategies, mainly covered calls, to generate cash flow. For example, take the TSLY ETF. It sells call options on Tesla stock to collect option premiums. That premium becomes income for the fund, which they then distribute to investors weekly. The same goes for ULTI, YieldMax Ultra Option Income Strategy ETF, which writes covered calls on a basket of stocks, aiming to generate massive short-term income. This approach can create those eye-catching yields, sometimes over 50% annualized, and consistent weekly payouts. But there's a catch: that income doesn't come from nowhere. It's tied to market volatility, and sometimes, the ETF gives up potential price appreciation. In other words, you're trading potential growth for income consistency. Let's talk about the positives, because there are some real benefits. 1. Consistent cash flow. Getting paid weekly can be a game changer, especially for retirees or anyone managing expenses. It feels like a paycheck, steady, predictable, and satisfying. 2. Psychological boost. Frequent dividends create a sense of progress. You see the returns every week. That emotional reward keeps investors engaged and motivated to stay invested long term. 3. Reinvestment opportunities. Weekly payouts allow for more frequent reinvestment, potentially compounding returns faster than quarterly distributions. 4. Diversified timing. With weekly ETFs, you can stagger payments, some pay on week 1, others on week 2, effectively building your own income calendar. So yes, there are legitimate reasons investors love weekly dividend payers. But before you get too excited, let's flip the coin. Now, here's the truth most marketing materials gloss over. 1. High yield doesn't equal high return. Many weekly dividend ETFs boast 30%, 40%, or even 60% yields. But remember, that's distribution yield, not total return. If the ETF's share price is dropping faster than your dividends come in, your overall return could still be negative. 2. Limited capital growth. Covered call strategies cap upside gains. So while you collect income, your investment might miss out on major rallies, especially in volatile, fast-growing stocks like Tesla or NVDY. 3. Tax inefficiency. Weekly payouts mean more taxable events, especially in taxable accounts. Those dividends often count as short-term income, not qualified dividends, meaning higher tax rates. 4. Sustainability risks. The weekly payouts rely heavily on option premiums. If volatility drops, those premiums shrink, and suddenly, that juicy weekly income can dry up or get cut drastically. And yes, we've already seen this happen. Several YieldMax ETFs have reduced their payouts over time as market conditions changed. So, the truth is that the weekly payments are not always as stable as they appear. Let's look at some real-world cases to make this clear. Take TSLY, YieldMax Tesla Option Income Strategy ETF. In its first months, it had massive yields, over 60% annualized. Investors flooded in, drawn by the weekly income. But then the ETF's price declined sharply, losing over 30% in value within a year. Yes, you received weekly payments, but your total portfolio value shrank. Then there's ULTI, which aims to diversify by writing calls on multiple tech stocks. It offers stability relative to TSLY, but still faces the same fundamental issue: it trades income now for growth later. Contrast that with monthly ETFs like SCHD or JEPI. They might not pay weekly, but their total return and dividend consistency often look much stronger over the long run. So again, it's about what you value, consistent income or total growth. If you're still intrigued, here's how to do your homework before investing. Step 1, check total return, not just yield. Look at both price performance and dividends combined. Step 2, understand the strategy. Is it selling options? On which stocks? How volatile are they? Step 3, look at dividend history. Are the weekly payments consistent, or do they fluctuate wildly? Step 4, review expense ratios. Many of these ETFs have higher fees, sometimes over 0.99%. That eats into your returns. Step 5, know your goal. If your aim is stable retirement income, mixing in some weekly payers with monthly or quarterly ETFs could work, but don't go all in. So, what's the truth about weekly dividend payments? They're real, they're exciting, and they can be part of a well-balanced income strategy. But they're not a magic money machine. Behind those frequent payouts are complex strategies that come with trade-offs: lower growth potential, higher volatility, and sometimes, unstable income streams. The best approach: use weekly dividend ETFs as a supplement, not a replacement. Combine them with strong, long-term holdings like SCHD, VIG, or VIME, ETFs built for steady, sustainable dividend growth. Because in investing, it's not about how often you get paid, it's about how much you keep and how sustainably you grow. Thanks so much for watching today's deep dive on weekly dividend payments. If you found this helpful, don't forget to hit that like button, subscribe to the channel, and turn on the notification bell so you don't miss future investing breakdowns. And let me know in the comments, are you investing in any weekly dividend ETFs like TSLY or ULTI? Or do you prefer stable monthly payers like JEPI or Devo? I'll see you in the next one, and remember, invest smart, stay consistent, and think long term.